So thank you very much. I think that is bei den Ökonomen auch anders wiederum belegt.
Yeah.
So now we move to the last session. So this structured a bit different, as I said. So we had the talk by non-economists, and the talk is commented by two economists. So Kern will talk on banking regulation and environmental sustainability. So it's also a nice opening to interdisciplinary discussion. And then we have a comment by Alistair and Eliana. Thank you.
Good. Well, thank you, Ekaterina, very much. It's a pleasure for me to be here today. It's great to be back in London. Also see former colleagues and Alistair and others. Over the years, I've carried on a fruitful collaboration. I've learned a lot about economic policy issues and financial regulation. And so what I'm going to present today has to do with this growing area of financial regulation and green finance. And this has become part of the policy agenda in the European community. The European Commission issued a report a few months ago by the high-level expert group on green finance. And one part of that report has a big focus on how regulation can be used as an instrument or a tool to help achieve a transition to a more sustainable economy. And so what I want to do first is, with my legal background, we always try to define what we're talking about. And so environmental sustainability is one of those areas that has a lot of different definitions in the literature. And so I want to start with that and then discuss kind of what it has been some of the recent literature on financial regulation as it relates to environmental sustainability, and then to discuss then what might be a potential research agenda. That would be an interdisciplinary one that would include both economists, possibly public policy analysts and political scientists, as well as lawyers, looking at how can regulation be used as an instrument to help build a more resilient banking and broader financial sector. And so, anyway, environmental sustainability, this is a definition taken from a well-known publication by scientists, by Johan Rockström and others. Planetary boundaries. Environmental sustainability has been defined as a state of society in which the demands placed today on the environment by man-made activity cannot be met without diminishing the environment's capacity to allow future generations to live well. So that's, of course, it's a very sound principle, but yet it's rather general in many ways. Environmental sustainability challenges consist of all man-made environmental risks. So we're not talking about non-man-made phenomena, but man-made environmental phenomena, such as not just climate change too, that can be classified as the 9 planetary boundaries, which if transgressed, humanity cannot continue to develop and thrive in the future. So climate change is one of these planetary boundaries. It's right there, but there are 8 others. And so when we talk about environmental sustainability, we're talking about a broad area of the environment where man-made activity can hinder the evolution of the environment and affect the economy and affect how we are living today. And so most scientists agree that of the 9 planetary boundaries, we have exceeded the thresholds for sustainable living or economic development in 3 of these areas: the loss of biodiversity, the nitrogen cycle, and climate change. And that the others are not yet exceeded, but in the future they could well be exceeded as well. So we have this scientific agenda. The science is more or less overwhelmingly in favor that we are reaching the tipping point in these different areas of the planetary boundaries, and that something has to be done to reverse the unsustainable living arrangements and economic activity that we have in today's economy. And so now, what about financial regulation? Why is it relevant? An emerging literature has begun to develop in the last 8-9 years that has looked at financial regulation and environmental sustainability from several perspectives. And so the early papers were focusing on disclosure. The issue was, well, companies that are listed on stock exchanges should be disclosing their exposure to carbon risk, for instance, high carbon sectors of the economy, and that these risks should be analyzed and considered to be material risk that can undermine achieving regulatory objectives and also be something that investors would be concerned about. I was commissioned to do a report 4 years ago looking at the banking regulation area, looking at Basel III. How could Basel III be utilized to identify environmental sustainability risks that might affect the stability of the banking sector? And so I led a research group in Cambridge at the time that consisted of economists and lawyers, and we basically had an empirical research agenda. We interviewed regulators from 28 or 29 different jurisdictions and basically collected information on what type of supervisory practices they engage in. How do they assess environmental sustainability risk? For example, do they consider environmental sustainability risk to be a proxy for credit risk or for market risk, like trading book risk? And so we came, and the conclusions were disparate. There was no real common regulatory approach for countries around the world. Countries had different, perceived that they had different exposures to environmental risk. Some countries like Brazil and Indonesia and Bangladesh felt that environmental sustainability risks were an important part of prudential regulation. It's part of the regulatory rule book for the banking sector. By contrast, other developed countries in Western Europe, North America, did not consider environmental risk to be relevant for prudential regulation. They were simply not in their regulatory practice book. And since then, Fabrizio and his co-authors wrote a paper at the IMF discussing policies to promote economic and social inclusion and how this improves the resilience to climate-related risk and supporting the UN's Sustainable Development Goals. So now the literature is beginning to expand. It started with looking at kind of disclosure, but yet now there's been work looking at it from a prudential regulatory perspective, also looking at it from a more macro-prudential perspective. And the UN published a paper in 2017, that was sort of a review of all the different international financial standards internationally that address environmental sustainability risk. Further, more recently, many of you are familiar with the Bloomberg Committee. That was based, their secretariat was based at the BIS, and they made recommendations. It was a task force that looked at how listed companies should disclose climate-related risk in their quarterly reporting and in their regulatory reports, and made a series of recommendations in a June 2017 report. This report concluded that any disclosure requirements should be voluntary. They should not be mandatory disclosure requirements, and this should be an industry-led initiative. But it does provide sort of an international set of standards and points of regulatory contact about how companies should be disclosing climate-related risk to the markets. Later, academics, Nagel and his economists, co-authors are economists. They made recommendations that basically that were supportive of voluntary disclosure framework. And then a lawyer, Johnston at Sheffield, has written an article arguing for mandatory disclosure, saying that we shouldn't just have voluntary disclosure frameworks, but mandatory disclosure is important to achieve standardization of disclosure requirements across markets. And then, of course, many of you are familiar with Mark Carney's speech in 2015. Carney gave his famous Tragedy of the Horizon talk, or his Mansion House speech. And in that talk, he highlighted the risk of an abrupt transition from an unsustainable, high reliance on fossil fuel economy to one that would be in the future more of a more sustainable, low fossil fuel dependent economic development model, and that the concern here is that if there's a sudden abrupt transition, it could create systemic risk, or it could create other financial stability risks that regulators should be concerned about. And so this has been, and so Carney's talk has been cited, of course, now in many of the recent academic papers in the last couple of years as being the first recognition by kind of a G10 type regulator that the climate change and environmental sustainability agenda does pose certain financial risk. And then since then, the Bank of England has produced one report on insurance, on saying how insurance companies can be regulated more effectively with solvency ratios, with risk-based solvency ratios that identify environmental sustainable assets and those so-called green assets, and then assets that are brown assets, and then maybe possibly penalizing insurance companies that have a disproportionate exposure to so-called brown assets. And also, the Bank of England is producing a report in 2 months. I've been part of a research group that has been working with some of their research team, and it's a report that deals with financial stability in the banking sector and what are the risks that banks in the UK may be exposed to that relate to environmental sustainability. And so the bank will produce another report in late October on that, similar to the report they produced in 2015 on the insurance sector. Someone had their hand up, or sorry?
Yeah. I just wanted to shortly ask in the slide before, what's the mechanism that is supposed to bring about any change stemming from increased transparency of investment?
Well, the idea is that companies should feel that there is a duty for them to assess their exposures to to sectors of the economy that are not environmentally sustainable, that have dependent on fossil fuel exposures, and then that they should collect this information. It should be part of the regulatory reporting and disclose to investors, so investors would then be able to see this information and then make a decision, do we want to stay invested in these companies or not, and that this would have an effect on the asset pricing of the companies across sectors. Yeah.
Why the market?
Yeah.
Go to market.
It's kind of the first step that regulation is sort of addressing this issue. It's all, there's more consensus on disclosure, who opposes more disclosure, that type of theory. It doesn't take into account fully, I think, some of the other asymmetric information problems that you have in the financial sector, and that's why the regulators are beginning to look at areas of bank capital regulation and bank corporate governance. Not just for the banks, but for insurance companies, and that's why the Bank of England has gotten very interested in this area. And then also recently, the European Systemic Risk Board has begun to look at this from a macroprudential perspective, and so the GDP. So you have the ESRB with a couple of reports in 2015, basically identifying broader economic transition cost that will happen if there is not a smooth transition to a low carbon economic growth model. Some of the central banks in Europe, most of them have not been have been very proactive in this area and assessing this risk, but the Dutch Central Bank has been. The DNB has had a small team that has been looking at these issues for some time now, and I had the opportunity to go present to them back in 2015 when my report came out. And but still there is a problem in the Eurozone because you can't really start regulating for climate change risk for banking regulation unless the whole SSM agrees to do so. You have to have a harmonized framework, a harmonized process for assessing risk in the single supervisory mechanism. So the DNB, although they've got teams working on these risks and assessing them and having conferences and inviting people to present papers, et cetera, the policy it hasn't really transformed into policy yet because the SSM has to accept this at the board level before they begin taking into account these sustainability factors. Other academics have done some work on direct exposure to stranded assets. I heard the earlier presentation, I think Dirk talked about the carbon bubble issues and so related to stranded assets and other areas where in the broader markets, when you've got the green bond market that's emerging now to take into account bonds that are issued by that are related to underlying assets that are either based on fossil fuel industry or more sustainable sectors of the economy, and there's a big focus on trying to have better pricing of these assets. That's more of a capital market regulation issue. And so there's a variety of research that's coming out now that's starting to address these concerns. I mean, should regulatory policy be involved here? Is there an asymmetric information problem that necessitates regulators to play a more interventionist role. And now internationally, some international bodies have considered the banking sector to be very important, because in most countries in the world, outside of some developed countries, the banking sector is the primary source of credit and investment in some cases. And so there's a real concern that the banking sector can be a source of credit that helps economies move to a more sustainable growth model and moves away from high carbon sectors and over-reliance on fossil fuel industry. And the goal is to transition to a low carbon economy that is sustainable. Now, 2 years ago, the G20 had a green finance study group, and they met. They had a number of studies and papers that were submitted, and they concluded in a final kind of summary paper at the end of the Chinese presidency. It was initiated by the Chinese presidency of the G20, that there were a number of significant barriers for generating more finance and investment in sustainable sectors of the economy. And so they classify these barriers basically as being market barriers, like market failure problems, asymmetric information problems, as well as institutional barriers, more political barriers, regulatory bias for the fossil fuel sector. And so there was a need to develop financial policy to overcome the market barriers and the institutional barriers to developing more capital investment in sustainable sectors of the economy. And so they classify efforts to overcome these barriers as being mobilizing capital and then mainstreaming green decision-making into financial decision-making more broadly. And so channeling capital to green assets through the banking system is one example of mobilizing capital. And as I said, in most countries in the world, banks are the primary source of credit. And then also for firms, investment firms, insurance companies, asset management firms, and also for banks, integrating environmental factors into their business strategy and governance and into their day-to-day practice. Too often in most banks and most financial institutions, environmental sustainability issues is put over in the corporate social responsibility department. It doesn't really have direct impact with risk management. It doesn't have really direct impact with business models and the development of new financial products. And so the G20 working group that looked at these issues did empirical work. They interviewed bank managers, they interviewed regulators, and they came to a conclusion that more work needed to be done to mobilize more capital and to mainstream environmental sustainability decision-making into bank financial management practices. And so as I look at this, I look at this from a regulatory perspective and from an institutional perspective. And of course, environmental policy has been very dependent on fiscal incentives. We know so far, either direct government expenditure or tax breaks to help support investments in more sustainable sectors of the economy. In many developing countries where you've got development banks have a policy objective of making more loans for sustainable sectors of the economy. This is the case in India. It's also the case in Brazil, where there's a couple of large state-owned banks. And so my area is what I'm suggesting that there be further research. What I'd like to explore further is the role of regulation, financial regulation. How can it be used as a tool to help steer the financial sector onto a more sustainable footing? How can regulation help firms evaluate the emerging risk and integrating prudential policy into the broader regulatory framework with respect to sustainability? Enhanced disclosure has been recognized by policymakers already as an important objective. Internationally, the only agreement, though, is that you have a voluntary disclosure framework. So with the Bloomberg Committee that issued the report last year. And also there is a concern or an emphasis on trying to understand the role of central banks. Should central banks be playing, should they try to facilitate a transition to a more sustainable economy through the use of monetary policy, through the use of the monetary policy transmission mechanism, for instance, and the types of collateral they take when they make loans to banks? Should they favor green assets as collateral for, and not, you know, high carbon bonds from Volkswagen? And so there's a policy discussion going on in many central banks about should central bank monetary policy also favor sustainable green assets. And so now I wanted to show you this chart because the study that I did, it was an empirical study. We had interviewed regulators all over the world. We'd classified their regulatory practices with respect to prudential policy and environmental sustainability. And so basically the blue countries here are the countries where there were mandatory prudential requirements regarding bank regulation and sustainability. So these are the countries: Brazil, Peru, India, Malta, Indonesia, China. These are countries where there were mandatory requirements, where sustainability factors were being integrated into prudential regulation, which is, now this is just simply on their own initiative. There's no international requirements for them to do so. China was probably the first innovator in this area with the green credit guidelines that were adopted in 2012. China, as we know, has a tremendous pollution problem, and that's why pollution and sustainability is an urgent policy matter in China. And the use of the banking sector to help steer the economy to more sustainable investment and supply of credit for sustainable assets is an important objective of Chinese economic policy. And so in China, they use the banks as an active instrument to help push the rest of the economy to more sustainable practices. And that's because, you know, the big four banks are state-owned, and also other Chinese, the banking sector in China is very influential, and the Chinese Banking Regulatory Commission has a pretty heavy hand, and what they want often gets done. In India, there are also mandatory requirements for prudential policy for both environmental sustainability as well as financial inclusion, social inclusion. And now the yellow countries are countries where there are no legally binding prudential requirements. And then the pink countries are where they have guidelines or recommendations, but not mandatory requirements. So there are a diversity of approaches internationally. And so there's no internationally harmonized approach. So we were talking about harmonization earlier. Should there be single regulation, the same type of regulation across jurisdictions? And we don't really have that in the area of prudential policy as it relates to environmental sustainability. And I think three countries that are really that provide very interesting examples of how they have integrated sustainability factors into bank regulation are China, Brazil, Peru. My time is limited, so I can respond to questions. Already there is self-regulatory initiatives internationally. Many of you probably know of the Equator Principles that were adopted under the oversight of the International Finance Corporation in Washington, so self-regulation for project finance and similar transactions. These are principles that banks, they basically say they will adhere to certain sustainability principles in making loans regarding large infrastructure projects. And then there is the Sustainability Banking Network. It's a group of regulators and banking industry representatives that meet at the International Finance Corporation in Washington, and they have just recently issued a very interesting report in 2018 that comes up with a set of standards and principles regarding environmental and social governance. So there's an emerging kind of self-regulatory approach to the monitoring and assessing of risk related to green finance. But however, the limits of self-regulation are that it usually reaches only the larger banks. Non-compliance is often limited. If the problem doesn't reach powerful NGOs and the press, clients will not be aware of the problem, so markets won't solve it. That's one of the critiques of relying on the self-regulatory model. And therefore, the argument goes there should be more international formal regulation in this area. The Basel Committee, for example, should play a role. And so as I look at this, I think some research objectives would be to identify some of the institutional and market barriers to enhance the flow of credit and capital for green finance, looking at some of the policy options on how to enhance the ability of the financial system to mobilize adequate finance and mainstream sustainable financial practices. And then to look at some of the recent reports building on a growing literature in this area, but this research would be more focused on, it would be more empirical. It would look at prudential regulation of individual financial institutions. It would not really address the central bank issues, which is more of a macro-prudential matter. Anyway, I've mentioned that internationally this has become topical. The G20 placed a great importance on this with the Green Finance Study Group in 2016. The Paris Agreement, of course, has got targets for countries to meet in carbon reductions. And the BIS has started a research project. I just met with them in January, and we have sort of an informal group that meets every 3 or 4 months to discuss green banking. How can we promote green banking? So the BIS, not really in the policy side, but just the research department of the BIS are now looking at green banking and its impact on bank corporate governance. So I'm running out of time, so let me just, some of the questions that research could look at. Do we need extra tax incentives to expand green credit guidelines? Do we need changes in environmental or labor regulation? Further cooperation from business associations to make information regarding E&S risk performance more accessible to banks? Should we develop a model of credit pricing that takes into account consideration of environmental and social impacts? Should banks have targets decided by regulators themselves regarding green social credit lines and investments? What about remuneration? Should that be part of it? The regulation of remuneration of banks, whether banks and financial firms are achieving sustainable targets. Should banks create a way to track environmental and social impacts of loans and investments and disclose this to their clients? One final note I should say is that internationally there's no agreement regarding how you define green assets or brown assets or high extreme brown assets. There's no standardization of defining this. Each bank which we interviewed in our research had an environmental sustainability group that worked on these issues, but they defined green lending differently from each other. The banks did, and the regulators didn't define it similarly either. They had different views on what were green assets, what were brown assets. So there's no international standardization of this. And I think that one of the important contributions that research could make, and also that policymakers could begin with, is to simply lay down some basic definitions, some basic rules regarding what are green assets, what are brown assets, and also not to make these harmonized across all countries, because what are green assets, say in Switzerland, would be different than what are green assets in Saudi Arabia, a country very dependent on fossil fuels. And so there needs to be a flexibility of implementation regarding the definitions between green and brown assets. But so I think there are a number of ways that research could proceed. I think what I would be interested in doing is looking at it from an empirical perspective and build on some of the database and the research that I and my research group I've worked with in Zurich have been doing over the last 3 or 4 years. So thanks very much for your patience. Sorry to run through this quickly, but I'm happy to take questions.